Welcome everybody to Safe Option Strategies presentation of Working with Options Part 2. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, and I've got some older option chains on here from the last time we did this class live, so I don't want you to worry too much as we go through the presentation. Don't worry too much about these dates and the fact that these are older dates. We are doing this live in the month of June of 2017, but these are option chains from last year. I had it set up exactly the way I wanted and didn't want to go in and change things. So the point of this this particular class is to help you get more familiar with working with options. Now, as a review, we talked in part 1 of working with options. We talked about our bid price, we talked about our ask price, and we talked about our last price on both the call side and the put side of options. And one of the things we emphasized is the importance of when you are placing a trade, when you're putting a trade together, it is very important that you look at the trade from the perspective of assuming that whatever option you're paying for, make the assumption that you're going to pay the higher price, and if you're getting a credit, make the assumption that you're going to take in the lower price. Now, as we begin the process moving forward past this class, we're going to start to put together trades. We're going to start to put together spreads. We're going to start to put together adjustment strategies and so forth, and it will become even more important that you analyze and look at your trade based on whether the worst case scenario, if you're spending money or taking money in, whichever is the worst case scenario for you, make sure it's still a good trade. Now, what I mean by the best and worst case scenario is this. If I'm buying something, I want the best price, right? If I've got two stores that are selling a product and one of them is selling the product for $5.50 and one is selling the product for $6.10, obviously I want to pay the lesser amount. But I've got to assume, for the purposes of options, I should assume I'm going to have to pay the higher price. And as long as the higher price is still a good price, in my opinion, doesn't mean I wouldn't like to get the lower price that I'm going to have to pay. It means that as long as the higher price is still a good deal, I can live with that. I can be okay with it. That's the perspective we need to have. That's the way we need to approach the options. Look at what the worst case scenario is for you and simply ask yourself, can I live with that? Is that still a good deal? If I'm a merchant, if I'm selling something, obviously I want to get more money for the item that I'm selling, but can I live with an offer that's only this high? Make the assumption that whether you're the buyer or the seller, you're going to get the worst of the deal. And then if it's still a good trade, if everything is still lined up and still looks good and still works well, then you know you've got a good trade, and you know that anything other than that is simply better. And that's the way to approach it. Now, this becomes very relevant when we start putting together orders. Just like with the previous class on working with options part 1, for some of you, this is just review. For some of you, this is nothing more or nothing less than a review of stuff you already know. For some of you, you're brand new to this. A lot of the trades we put together are going to involve one option that we sell and one option that we buy. I've got this reversed. That when money is going out of our account, I usually have it highlighted in red, and when money's coming into our account, I have it highlighted in green. So a lot of the trades we do involve an option that we buy and an option that we sell. And if we assume the worst case scenario and determine if the worst case scenario is a good deal, in this case, we're looking at buying the 50 strike option, selling the 52.50 strike option, assume we're going to have to pay this price, assume this is the best price we're going to get for the money we take in, and therefore assume that our worst case scenario is $1.16. Now, when we're evaluating this trade, and we see that $1.16 right there, a lot of times we will say to ourselves, based on a risk to reward ratio of this trade, it's still a good deal for me. It's still a good deal, even if I have to pay as much as $1.25. And this is my way of introducing limit orders. Okay, when we're working with options, now you can do this with stocks as well, but it becomes, in my opinion, a little bit more important to do it with options. When you are working with options and it comes time to actually make the transaction, the long option is always going to be a buy to open. And if we're buying to open it, that means automatically that we're going to sell to close it. Okay, the short option, think back to our lesson on the 4 option instruments. A short option is going to be sold to open. This is the one we're going to take money in on. And therefore, we're going to buy to close it. To close out a short option, rather than just letting it expire, we got to buy it back. If we sell somebody something, we change our mind, we want it back, we got to buy it back. Okay? The combination, when we open a trade where the amount of money we're going to be paying out, okay, I want you to look at this. Here's our long option. This is the one we're paying for. And it corresponds with this down here. If you'll notice, the bid price here and the ask price here match up with our bid and ask prices right here. Okay? This is the option we're paying for. This is the option we are getting paid for. This is the one we're getting a credit on. If the net result is that money is going to leave our account, so money's coming in on one option, it's going out on another option, but the net result of the two of them is that we're going to spend money. Money is leaving our account. Even though one leg of the option is buy and one leg of the trade is close, I said one leg of the option. What I mean is, even though one of the options is a buy and one of the options is a sell, I'm getting all tongue-tied. The overall trade, if money is going out of our account, the overall trade is a buy to open trade. When the overall result of the option we're buying and the option we're selling is money out. Okay, I use this abbreviation a lot. Get used to this abbreviation. When the overall net result is money out, we are buying to open the trade. I don't know why that other line jumped in there. Sorry about that. Okay, you need to remember that. We buy to open the trade. A buy to open trade, another way of saying it, is that it is a debit trade. When we place a trade where money is going out, we can call it a buy to open trade. It's oftentimes referred to as a debit trade or a debit spread. The next class after this, we're going to introduce you to what spread trades are, but it's important to know some of this terminology to set the stage. Okay, we buy to open. A limit debit order means this right down here, this limit debit or limit credit order, this is an instruction to our broker. When we are placing this trade, we are going to present our broker with instructions, and a limit debit order means Mr. Broker, Mrs. Broker. This is the trade I want to open. I want to buy this 50 strike. Let me clear up all my marks here. Let me make this easier to read. Okay, I want to buy to open this 50 strike call, and I want to sell to open this 52.50 strike call. And right now, the current worst case scenario is $1.16, but I still believe this is a good trade to get into as long as I don't have to pay more than $1.25. When we are opening a debit trade, when we are doing a buy to open trade, we want to limit the total amount of money that we are paying to be in this trade. Now, sometimes that number may be in between our worst and our best case scenario. We might have a trade that says $1.10, approximately halfway between our best and worst case scenario. Actually, 90 cents would be closer to halfway between, but that's okay. We may say that the trade is great at $1.16, but we could still live with it at $1.25. This limit debit order, the instruction this gives our broker is, open this trade for me as long as you can do so for a net debit of $1.25 or less. I want it less than or equal to $1.25. You remember back to high school and college algebra, we have the symbol equal to or less than, or you could put the symbol the other way for less than or equal to. We want it to be equal to or less than $1.25. In other words, the communication we're giving to our broker with this limit order is, do not open this trade for me if it's going to be more than $1.25 as a net debit out of my account. The reason we use these limit orders is because during the day when the market opens, these prices are constantly in flux. They're moving all the time. A huge spike in the price of the stock, up or down, could change these option prices enough to cause this to be higher or lower at the time we're trying to get in. And we want to make sure we're getting in at the price we're looking at or better. And that's what that limit debit order does. In a case where we might be looking at an overall net credit, in this case, we're selling the 47.50 option and we're buying the 42.50 option, and the credit we're taking in here is bigger than the debit we're going to pay here. But to make this a good trade for us, we want that debit to be at, or that, excuse me, that credit, we want it to be at least $1.30. So once again, we're selling one of the options to open it, we're buying the other option to open it, and the net result of all of that is a sell to open. If overall, when we buy one option and sell the other option, there is a net credit, and I oftentimes talk about money in, it means that we sell to open this trade. Even though one of the options is being sold, the other option is being bought, the net result is that we are selling to open the trade because there's a credit coming in. This instruction right here to our broker says, Mr. or Mrs. Broker, I love this trade if I could get a $1.71 credit. I'm okay with this trade if I only got a $1.34 credit. But do not open this trade for me if it's going to cost me more, or excuse me, if I'm not going to get at least $1.30. It's not a good trade in my mind if I can't get at least $1.30 per share. So when we are opening options, now the same thing applies. I'm showing you right out of the gate, and this is kind of a preface to getting into and talking about spread trades. But even if we were doing just a single option, if all I was doing was selling this option and there was no option being bought at the same time, I can still say to my broker, look, the worst case scenario, remember, I'm the merchant now, I'm selling a product. I should assume I'm going to get the lesser of these two numbers right here. So I'm looking at this and saying, this is a good deal at $2.38. It'd be better if I could get $2.36, but it's a good deal if I can sell this for $2.38. I could put a limit order in here that says to my broker, don't open this for me if you can't get me at least $2.30. I'm giving you a little bit of wiggle room between here and where I still think it's a good deal. I'm giving you a little bit of wiggle room there. But I'm telling you, if you can't get me at least that much credit, don't open the trade. If I were just buying this option and I was not selling any option at all, and I said, okay, I'd like to be able to buy this for 89 cents. I'm still okay buying it for $1.09. And I'm even okay if I had to pay as much as $1.15. But if it's going to cost me more than $1.15, Mr. or Mrs. Broker, don't buy it for me. Don't open that option for me if you can't get me at least $1.15. Or if it's going to cost me more than $1.15. Okay, we use limit debit and limit credit orders a lot when we are opening trades. Let me give you a recommendation right now that you become accustomed to and that you get in the habit of doing, or at least do this early on. You don't have to do this all the time. If you are confused on how to create the proper limit credit or limit debit order with your broker, get on the phone with them. Your broker has customer service people who will teach you the right way to set this order up so that you're opening or closing it with at least a minimum credit that you're going to be happy with, or no more than a certain debit that you're going to be okay with. Now, if we buy to open a trade, okay, I'm just going to abbreviate this by saying buy to open. If we buy to open a trade, when it comes time to manually close that trade, we are automatically going to sell to close the trade. If this represented money out, now it's time to get money in. And if our money out was $1 and it's time for money to come in and we had a target profit of 20%, we're going to set a limit credit order of at least $1.20. If a dollar went out, we want $1.20 to come in. That's how we get our 20% return. So if we buy to open a trade, we are going to sell to close a trade. If we sell to open a trade, that should be a C for close, sorry. If we sell to open a trade, we will buy to close the trade. And in this case, we would have taken in a credit, money in. And if our money in was, say, $1, we would want our money out to maybe only be 20 cents. We'd want to keep the majority of what we brought in. When you are closing a trade, when it comes time to close a trade, look at which one is going to, now this is buy to close, this is money out. Okay, money is going out to buy to close this. Money is coming in. Oh, I don't know why that says sell to open. That should say sell to close. That's a mistake that I did not fix from the last time I did this class. Okay, if we're going to buy to close this, this is money going out. If we're going to sell to close this, this is money coming in. In this case, we're telling our broker, listen, we need at least 50 cents to, in the net result of these transactions, we need at least 50 cents to come back in. Okay, this is an overall sell to close order where we're expecting more money coming in than what is going out as we close this order. I always forget that I have these. This should say buy to close. This is the danger in using slides that I did a while back and forgetting that I was going to make corrections on them before I did them again. So in this case, we're going to sell this option, money in, right? We're going to buy to close this option, that's money out. And this is telling us that our best case scenario would be $4.30 money in. Our worst case scenario would be $3.35 money in. And we're saying to our broker, based on what I opened this trade for, I want at least, don't close this trade for me if you can't get me at least $3.50. Now, as we go through, I know for some of you this is still a foreign language. It will help as we begin to go through the individual strategies and put together the individual trades. We will set up each individual trade for you and show you exactly where you should set a limit credit or a limit debit order. What I want you to remember right now when you're working with options, and as part of your understanding of how options work, is when you buy an option, you're typically going to do so with a limit debit order. When you sell an option, you're typically going to do it with a limit credit order. And the same is true when you're closing an option. When you're closing an option, you're going to do it with a limit credit order. When you're closing a long option, when you're closing a short option, you're going to do it with a limit debit order. This is just an instruction to your broker. Whatever I'm asking, don't do it for less than this, or don't do it for more than this. Now, I'm going to shift gears and I'm going to talk a little bit about the Greeks. One of the things, a lot of people come to the Safe Option Strategies education and they have had some training or some education in deltas, gammas, theta, vega, and we refer to these as the Greeks, okay? The Greeks are theoretical data. What the Greeks are, with every one of these option strike prices, with every one of these options that has an expiration date and a strike price, there are corresponding information with that that tells us how much these prices should change up or down based on other things, based on what's going on with the price of the stock. For example, the delta. Every option has a delta. A delta shows you how much an option price should move with each corresponding move of $1 of the stock price. So the delta should show us if the stock is moving up $1 and we had a delta of 0.50 on that option. If the stock price moves up $1, this is telling us that the option should move up approximately 50 cents. Okay? I'm not going to spend a lot of time right now going through all of the Greeks and explaining all of the Greeks in detail, and let me explain to you why I'm not going to spend a lot of time with that. What I've got for you on the next several slides is what are deemed to be the most important Greeks. Now, there are a couple others that are left off of here. I'm going to leave it to you to study those on your own if you choose to. The delta, the vega, the gamma, and the theta are the four most common used Greeks. Honestly, with the delta being the most common used Greek information. The deltas are part of options used to help you determine how much movement you need in the price of the stock, or how much time decay you need in the option to achieve your target or what you're looking for. It just, that's all they do, is they help us determine how realistic our chances are of being profitable with a long or a short option. That's what their purpose is. One of the problems, or one of the challenges that I have, is a lot of people come to the Safe Option Strategies education and they put far too much focus on the Greeks. Rather than me going through each of these, you can go back, if you'd like to, when you look at now those of you that are on live, it's going to seem like we're just rushing right past this. For those of you that are listening to this as a recording, take a moment and pause your screen and read through this definition. Take a moment and pause your screen and read through the definition of what the vega is. Do the same thing with the gamma. Do the same thing with the theta. Each one of the, I'll go back and leave it on gamma for a minute for those that are still trying to pause it. Okay? Take a minute, pause it, read through this. Take a minute, pause it, read through this. When you're watching a recording of this class, there is also on the web page right underneath this, there's the PDF version of all of these slides, and you can print that off, or you can go right to that and look at each one of these. It's not a bad idea to familiarize yourself with what this information is and what this information means, but this is what I want you to remember more than anything else about the Greeks. They are theoretical data. Never, ever, ever forget that it's theoretical data. It is constantly moving. As the price of the stock is moving, the rate of decay moves. As the price of the stock is moving, the delta moves. It's not always, when you start out with a delta of 0.50 and you start calculating and saying, okay, for every dollar the stock goes up, this option is going to go up 50 cents because I've got a 0.50 delta. Well, once that stock price has moved $1, the delta may change from 0.5 to 0.4. Or it may change to 0.6. It's constantly moving. So where it's at right now today is not necessarily where it's going to be at tomorrow. And where it's at tomorrow might reverse and be back to where it was at yesterday. The Greek information is constantly moving. It's not nearly as reliable as what we wish it would be. It would be so nice if we looked at the delta and were able to say, okay, I know for a fact, because this is a 0.7 delta, I know for a fact that if I get $3 movement up on this stock, I'm going to make $2.10 profit on my option. That would be 0.7 times $3 movement on the stock, 2.1. That would be wonderful if it happened that way. And it never happens that way. It never happens the way we expect it to happen because it's theoretical data. It's constantly in flux. It's constantly moving. There are very, very few instances where the numbers we see in the delta, in the gamma, in the theta, in the vega should be the deciding factor in whether we place a trade or not. It doesn't mean we ignore them. It doesn't mean we factor them out of the equation, but oftentimes the Greeks get people hung up and get people stuck in the mud and bogged down in too much information, and they can't decide whether to place a trade or not, or whether the numbers are good, or whether the theta decay is going to be fast enough, or whether the gamma is going to affect the delta quickly enough. It is so easy to get bogged down in the Greeks. And in a lot of the trades, it's irrelevant. Yeah, and this should say not as reliable. Sorry. Joseph just corrected me, and thank you. I just missed a simple typo when I was putting that together. That should say not as reliable as we wish it to be. So I want you to remember that about the Greeks. I'm not suggesting you ignore them. I'm not suggesting you discount them. I'm not suggesting that it's a bad thing if you've learned a little bit of information about the Greeks and you know how to use that information, but I want you to give it the proper weight. I want to make sure as we go through and we start putting together strategies, as we start teaching different specific trades, that you don't ever let yourself get hung up on the Greeks. Now, as we continue to move forward with the individual strategies, there will be a little bit more inserted here and there about how the options work. We've covered what we need to about strike prices, about expiration dates. We've covered what we need to about weekly and monthly options. We've covered what we need to about ask price, bid price, last price. We talked a little bit in the previous class about volume versus open interest. As we move forward, we will continue to add information, but these last two classes, this class and the one before, should give you the most basic understandings of how the options themselves work, and you'll add upon that and increase that as we move forward. We buy to open debit spreads with limit debit orders. We sell to close debit spreads with limit credit orders. This is telling our broker we want a maximum money to go out. This is telling our broker we want a minimum amount of money to come in, at least a certain amount. When we start doing credit spreads, and we're going to teach you what all this is, we open them saying we want a minimum amount of money to come in to open this, and when we're ready to close it, there's a maximum amount of money we want to go out. There will be times, and as we go through individual strategies, we'll help you understand this. There's just a little simple concept I want to get you familiar with, but we're going to talk, this is more a segue into the next class than anything else. There are some trades and some situations where it's going to be very advantageous, even though you're going to be opening two legs of a trade, you're going to be opening a short option and a long option and putting them together as one spread trade. There are going to be a lot of times where you open those together, and that's kind of the example of the orders that we gave previously in this presentation. But there will also be times when it will be advantageous to open one side of that trade first, make sure you get a good fill price, and then open the other side of that trade and get a good fill price on that. So that's kind of a segue into a little bit more of what we're going to learn when we talk about an introduction into spread trades, and then the real fun comes. We've laid the foundation. Now we're going to be ready to start framing the house and start getting you the specific strategies that are going to help you be a profitable trader. Thanks, everybody. That wraps up Working with Options Part 2, and we hope you enjoyed this class and look forward to the next one. Thanks, everyone. Bye-bye.